Hey guys, welcome back to the channel. In today's video, we're going to go over 3 stocks that I think you might want to potentially add into your watch list. I've definitely got them on my watch list, and today we're just going to go over some reasons why I think they might make potentially good investments. We'll also discuss some of the things that you might want to actually look a little bit deeper into before you decide whether or not it's worth putting any money into. Now, I'm not actually going to go so deep as to actually provide a buy price or a target price or anything like that. I'll leave that up to you to decide, but I'll briefly go over some reasons as to why these companies are on my radar and why I'm looking a little bit deeper into them. And if you guys are new to the channel, I like to make a new video every single week, just talking about personal finance and just how to handle your money, and really hoping to help you, get a little bit closer to your financial goals. So if you haven't already, do like and subscribe to the channel. It's a big help just by clicking the button down there. And of course, turn on your notifications just so you get notified every time I post a new video, especially if you like this type of content. Hey guys, now we're at the computer and we're going to look at the first company for today. So the first company that we're going to look at is actually A2 Milk. Now, if you're in New Zealand or Australia, you would have definitely heard about A2 Milk. Just recently, this was like a market darling here in New Zealand and in Australia. And what the company does is they're a provider of milk products, of dairy products, specifically products that contain the A2 milk protein. So they provide fresh milk and they also provide infant formula, right? So they sell it into New Zealand, into Australia. Recently, they just opened up in the United States, not a big part of the company, and they also sell a lot into China. That's just a really quick overview of what the company does, and the reason why these guys are actually on my radar, as you can see, I've got this stock chart here, right? And just up until about a year ago, these guys are trading at almost $21 per share, and as of right now, they're trading at $5.97 per share, right? So, almost a 70% drop in the stock price, which would obviously attract a lot of investors, a lot of value investors in particular. And the reason why the prices actually dropped quite a bit is because of the pandemic. Now, when the pandemic hit, it closed down a really big part of the company, which is the Daigou channel. Now, the Daigou channel essentially is just a reseller channel. It's a reseller market whereby customers in Australia will buy the company's products, particularly the infant formula, and they'll actually resell it into China, right? So this was a really, really big part of the company's revenues, and where they made a lot of their revenues as well. Now, and because the borders are shut in Australia, there's essentially the Daigou channel's basically died down for them. Now, they are in the middle of trying to reactivate the Daigou channel, but as you can see, they haven't been very successful. Let's have a quick look into the key stats of the company. Let's jump into Quick FS now. Just looking at this over here, as you can see, return on assets, return on equity, return on invested capital, all double digits, well over the 10% mark. And you can clearly see already why this company has come onto a lot of people's radars, right? It's because fundamentally, the company is not only a high grower, but has some really, really solid fundamentals behind it, right? Look at the revenue growth, look at the asset growth and free cash flow growth over the last 10 years. So really, really, really solid fundamentals in the company. If we jump into ticker and just look at a few metrics just a few key metrics really quickly, right? So in their income statements, look at their revenue growth, right? You can see just from this chart, year on year, the growth is pretty obvious. In ticker, it actually shows, right, just the change of percentage year on year, right? And you can see from 2016 right up into the last, the trailing 12 months, there's been just fantastic growth in the company. Also, if we scroll down to their weighted average diluted shares outstanding, you can see that yes, they have been issuing shares over the last couple of years, but it's slowed down significantly, right? Because the company, you'll see in a minute, is very, very cash flow positive, right? Now, you can see it has been growing, but it's pretty steady, right? So that's not a big concern. Let's look at their balance sheet. Now, when I quickly look into a company's balance sheet, I like to assess, what their, debt levels are like, or how strong the balance sheet is, right? So just look at the balance sheet very quickly. Total current assets, trailing 12 months, right? We're looking at over $1 billion in total current assets. And then we'll look down at the total current liabilities, and just straight away, guys, you can see a company has a really, really strong balance sheet, right? Essentially, they can take care of that with their current assets. And if you look down even further, total liabilities, you can see here that the company can actually take care of all of their liabilities with just their current assets. Now, what that means is the company can essentially just pay off any kind of debts that they have within a year. They can do it tomorrow if they wanted to. A good way to look at this, total current assets are basically assets that are very liquid and you can turn into cash within a year, right? Or very, very quickly. So just looking at their total current assets, they can take care of any debt that the company has, you know, tomorrow, next week if they wanted to. So balance sheet is a tick for me. Very, very strong balance sheets. You can see why this company's on the watch list at the moment. Now let's look at the cash flow statement, see if they're cash flow positive. Write down cash from operations. You can see that the cash from operations has just been growing, you know, insanely. And you'll see here this you know, between the 2020 and the trailing 12 months, you'll see that significant difference there, right? There's a big drop off, and that's where the downgrades that they've recently announced really comes into play, right? And that's where a lot of the uncertainty sort of lies, right? But you know, just looking at the cash flow statement alone, you can see if you minus the capex, right, you'll see that there's a lot of free cash flow. The company sits on a lot of free cash flow. So I always like to see that as well in the company when, you know, when they come onto the radar. So just by looking very quickly at the fundamentals of the company, guys, you can see why it's on the balance sheet. Now, a couple of things that you'll have to sort of figure out yourself before investing into this company. One, how quickly are they going to get that Daigou channel restarted? Because you know, at the moment, it doesn't look like the company is anywhere near or even has any clue of how they're going to restart the Daigou channel. Hence, the 4 downgrades that they've had in the last couple of months. It's not a really good look for me personally. It's not a good look to see management come out 4 separate occasions and just say, we've missed the mark on this one. We're not going to make as much money as we initially thought we would. We're going to have to downgrade our forecast for the rest of the year, right? Well, for the 2021 year. So just the fact that management's down that 4 separate occasions kind of doesn't instill a lot of confidence for me personally that they've got it under control and that they're going to turn it around very quickly, right? So that's one risk that you want to look into before investing into the company. Another thing that kind of stands out for these guys for me is I don't trust their management, not only because of what I just mentioned earlier, but you know, before this massive dip actually happened, you know, before this big slide that we see here happened, one thing that really stood out was that management was selling a bunch of shares, right? So there's a lot of insider selling happening, and on the surface level, it looks like management knew that they were heading for this dip and then decided to kind of head out and leave everyone else holding the bag, right? Which is not a good look. You know, that's not a good look for management. I'll give them props because they've actually, you know, before this all happened, they obviously got the company to where it's at, and they've been doing whatever they were doing. It was working. But it's not a good look to see management kind of leave everyone else holding the bag, you know, kind of taking profits off the table, knowing that this was most likely going to happen. So that's another red flag for me with this company. Now, what am I doing with it? I'm not actually buying it. I haven't bought any shares into A2 Milk. I do have them on the watch list though, because if another downgrade does come out, or if the shares, you know, continue to slide into that $4 range, maybe even that $3 range, then, you know, I'll really get interested, because if it just gets down to those levels, it's just kind of ridiculous kind of valuation, and they'll definitely be, in my opinion at least, you know, they'll definitely be mispriced, at least right at those valuations. So A2 Milk is the first company on the watch list for me. You'll have to go dig a little bit deeper if you want to, but you can clearly see why I have these guys on the watch list. All right, guys. Now the next company I've actually got on the watch list now is a company called Turtle Beach Corporation. Ticker symbol here, HEAR. So what these guys do is essentially they make headsets for gaming consoles, right? PlayStation, Xbox, Nintendo, PCs. Their biggest product is they make headsets, right? Now, these guys obviously came onto my radar because I'm a big fan of gaming. You know, I like playing games and whatnot. But particularly why these guys are on the radar is because they're trading relatively cheap compared to their competitors, right? To other gaming companies, the likes of EA Sports, Blizzard. These guys are trading, the metrics that these guys are trading at is pretty cheap, right? So for example, EV to EBITDA is 7.2, PE ratio of only 11.3. So right off the bat, you can see that they're actually trading really cheap. But does that mean they're a good company? Right now, if you look a little bit closer, if you look at their metrics here, right, return on assets, these look terrible, right? And that's due in large to back in 2011 to about 2013. They did have a reverse merger with a company called Hypersound, and that company was never profitable. It never actually turned a profit, and it's become a smaller and smaller part of the company as the years have gone by, but it never really turned a profit, and it really kind of hurt the returns of the company, right? But however, if we look over a little bit closer into, you know, the individual years like 2018, 19, and 20, you will definitely see there's some significant growth in the company, right? 2018, 70% in invested capital, 25%, 55%. You can see that they've actually become profitable, and you can really see that there's a lot of, you know, 511% on return on equity, return on assets. And right now, the company seems to be turning it around, and it's still trading pretty relatively cheap for the growth that it's actually been showing the last couple of years, right? Now, let's have a closer look into their financials. So let's look at their income statements. So let's look at revenue. Right off the bat, top line, you can see 2016 to the last trailing 12 months. Huge growth here. So that's a tick from me. Something that is kind of a red flag is just their shares outstanding. You can see that the shares outstanding have steadily been growing. So they have been issuing more shares as the years have gone by. Now, in early years, that wouldn't make sense because they're probably a young, growing company trying to invest in their growth. But, in recent years, they've actually become profitable and they've actually had a lot of free cash flow. So it is still kind of a red flag to see them slowly diluting shareholders. So that's something you would definitely want to look into. Now, if we look into the balance sheets, again, always wanted to see what their debt levels are like, what kind of equity you'd have in the company. Now, current assets, right? If you look at the total current assets, where is it? There it is. Total current assets, 169.98. Total current liabilities, definitely a tick and a tick there. And then total liabilities, this is a huge tick again. So again, you can see they can take care of all of their debt whenever they want to. Essentially, they can take care of their total liabilities with just their current assets, right? So that's a fantastic, very strong balance sheet, and I like to see that. I really like to see that in companies that that are potentially looking into investing into. Now let's look into their cash flow statement. Right off the bat, you can see cash flow operations. You can see the company really turning around, right? Because from 2017, from 3.42 million right up to the trailing 12 months of 54.61 million. So massive growth in their cash from operations. And you can see they're not, you can actually see right with their capital expenditure. Sorry, I'll unhighlight. You can see from the CapEx, they're not a super heavy CapEx type of company. If you subtract CapEx from cash from operations, you can see they've got plenty of free cash flow and it's definitely growing. So again, guys, a really fast growing company that's trading relatively cheap, right? Even compared to its peers, compared to its competitors, it's trading relatively cheap. And also it's a stock that has very, strong fundamentals and a strong balance sheet. So that's definitely why they're on the radar for me. Some of the tailwinds the company has going for it is obviously the esports market is growing. It's kind of been exploding the last couple of years. Esports has been taken more and more seriously now as a sport, and it has a really wide audience, and it just seems to be growing, right? So gaming is not just for young teenagers and kids anymore. You've got people who are well into their mid-20s, well into the early 30s that are still gaming, myself included. I still love playing games. I still love gaming. And you can definitely see that the company has a lot of room to grow. The way the company is growing their revenues over the last 10 years, look at that. The 10-year CAGR of 89.4% is an insane growth rate for this company, especially at the valuations that they're trading at the moment. Also, even with all this growth, the company just recently acquired Rocat, which now means they can actually expand the company a bit more. They're now producing keyboards and mouse and really moving more into the PC market because they actually own market share of the headsets, but only for the console side of things. So the fact that they have the potential to sort of take a really big foothold into the PC market as well, you can actually see just how much room there is left for the company to grow, right? So, have I purchased into this company? No. And the reason why is because I've got the 1 month chart here for a reason, because I started looking at this company literally a couple of weeks ago. I was reading into them. I was looking at them around this $26, $27 per share mark. And literally as I was getting more and more comfortable with the company, understanding the company, and really beginning to like the company, it literally just kind of ran up on me, right? Like, I mean, 36% in the past month is just... by the time by the time I was comfortable to making investments at the valuations that I've done, it was already it already gone up 36%. And to be quite frank with you guys, I didn't pull the trigger just because for me, I just didn't feel like I had enough of a margin of safety. And despite all the things that I said about the company, I just feel like I'm not smart enough to outsmart the market, whereby all the growth that I think the company has, whereby all the tailwinds I think the company has behind it, the market would have already sort of priced those things into it, which is why you see this massive run up in the stock in just 1 month alone. So what am I doing with the stock? I'm really just keeping it on the watch list, just keeping a close eye on it, because if it comes back down to that range that I was looking at before, then I definitely could get very interested in maybe opening a position in the company. But as for now, it does stay on the watch list. I am disappointed that it did kind of run up on me, but those kind of things happen, and this is where you sort of just exercise your patience as an investor, because eventually it will come back around to a price where you might be comfortable buying. So just leaving this one on the watch list, definitely a good company for you to consider maybe adding to your watch list. and doing a bit of digging yourself, you might even find that at this price, it could still be trading at a big margin of safety for you. Just for me, I'm trying to be a bit more conservative. So just kind of watching how this one goes and how this one plays out. All right, now guys, the last stock that I'm actually looking at today is a company called Redbubble, and they actually trade on the ASX under the ticker symbol RBL. Now, Redbubble, what do they do? They're actually just an online marketplace. They're a three-sided online marketplace whereby you have creators who submit the designs, and then you have customers. If you like the design, you can then actually choose to have it printed on a t-shirt, on a mug, on whatever product that they sell on it. They do stickers, they do bath mats, they do over 100 products. But essentially, you have artists who put up designs who are then liked by customers who can then actually have those printed on the different items, and that's actually then delivered, manufactured and delivered by Redbubble and delivered to the customers, right? So it's a really interesting online marketplace, and this one actually came onto my radar from a YouTuber called Investing with Frank. You guys should check out his channel. He does really in-depth analysis on companies. I really like the way he looks at companies. I agree with a lot of the things he says, but let's look at and take a closer look at the stock, right? So right off the bat, you'll look at some of the metrics here, the return on assets and the return on equity and whatnot. Not the prettiest, right? If you're a Philtown, very strict Philtown style investor, you are definitely going to be running for the hills. You're not even going to take a second look at this one, because those all look very bad, because the company wasn't profitable right up until recently, right? So for this one, you'd have to take a bit of a deeper dive into them. Now let's look a little bit closer at their fundamentals, right? So you can see right off the bat the kind of growth that this company has and has experienced the last couple of years, right? From 114 right up to 620 the last trailing 12 months. So that's a tick for me there. Now, I'm not surprised if you do look at their shares outstanding. It has been growing significantly over the last couple of years, but they're a young company that's been growing and growing, which is why they've been issuing shares, and that's why you see such high growth on their top line. Let's look at their balance sheets. Again, a very important metric is to look at their debts, what kind of debts, how heavily leveraged the company is. Now, if you just look at their total current assets, trailing 12 months, 143 million, down to their total current liabilities. I mean, they can take care of their total current liabilities easily. And then total liabilities, again, guys, a very strong balance sheet. You can see kind of a common theme with some of the companies that I look at. A very strong balance sheet. It's really important to have a strong balance sheet, because it's really hard to go broke, right? When you don't owe anyone, when you have more money than you owe people, essentially, right? So and in this case, they would have to actually try to go broke, right? So very strong balance sheet. That's a tick for me. Let's look at their cash flow statements. Cash from operations, you can see from 2016 it was a negative, and then the last couple of years they've just exploded, right? And also you'll notice another plus about the company is that they are a very capex light company, right? So you can see 0.43 capital expenditure, right? 0.55. Compare that to the cash from operations that they're making. You can easily see, do the math very quickly, even I can do it, that they have a lot of cash flow, very cash flow positive company, and they're sitting on a lot of cash. I will say, however, these 2 years, the company did come out and say that because of the pandemic, they were a very big beneficiary of the lockdowns, right? Because everyone sort of moved to ordering online. And so they essentially said in one of the 10Ks that they experienced 10 years of growth in a matter of months, right? So looking at this jump, which it does stand out, right? 46 to 85 just in the trailing 12 months. Now you do have to sort of figure out yourself and do some thinking yourself. Is that a normal, is that a normalized, cash from operations for them? Is that going to be normal cash flows for them? Because we're not going to have a pandemic every year. Things are eventually going to open up, and it'll be interesting to see how people sort of interact with the online shopping, whether the culture really has shifted more towards the e-commerce side of things, or whether people are going to go back to shopping and whatnot, right? So that's definitely something to keep in mind if you are going to do evaluations, whether you want to base your baseline cash flows on these kind of outlier years, right? But other than that, you can still see they've got fantastic growth and just top line fantastic growth, balance sheet very strong, and now very cash flow positive, right? Now stock price, they're currently trading at $3.38, and I really got interested in this one because just in the last month, I think, so I really began to get interested in this one when the stock price dipped from this $5.56 range down to where it is now. And the reason why it actually dipped is because the CEO actually came out with an announcement saying that over the next year or the next year and a half, their EBITDA margins are going to be are going to decrease significantly. Right now, the EBITDA margins are only around 9%, but he came out and said, essentially, we're going to be reinvesting a lot more into the company. You know, we're going to be trying to focusing on reactivating artists. We're going to be focusing on, you know, getting more loyal customers and improving the fulfillment side of the business. And because of all this extra spending on marketing and whatnot, you know, the EBITDA margin is going to look more like the mid to low single digits. So maybe around like 5% or things like that, right? Now, the market didn't like that at all. And because of that, the company slid down, you know, almost another 30 to 40%. Right, and that's where I really got interested in the company around this $3.38, right? Because that massive drop, it, you know, again, it didn't change any of the fundamentals we just went over in the company, right? It's still a I really like the business model of the company. They've got this flywheel effect going on, right? Where essentially, because it's a three-sided business, and this flywheel effect essentially states that if no matter what side of the business they invest in, whether it be on the artist and content or the loyal customers or focus on fulfillment and operations, the theory is whatever side they're going to invest in, it's going to benefit the whole of the company, right? So for example, if they really focus on like artist activation and bringing more people on board, more artists coming on board is going to lead to them having more designs for customers to choose from, right? And more designs means more unique products that customers can choose from. And if there's more designs to choose from, more people are going to be attracted to Redbubble and start buying more products, right? And more products and more orders from these loyal customers will then mean more work for the fulfillment and operations side of the company, right? So we've got a bigger look here at it. So let me just move that here. So you can see here, right? So this is what I mean. So if you invest in the artist and content, it's going to lead to more options for the customers, for the loyal customers, and then that's going to lead to more, you know, work fulfillment for the fulfillment side of the company, right? And you can see they have that sort of economy scale kind of thing going on. And I really like that about the business. And this kind of plays a big role inside of the competitive advantage, right? 'Cause at the moment, they don't have a direct competitor in the sense that there's no online marketplace that does the fulfillment side of the operations as well. And they're not a print on demand marketplace, which is something that Redbubble does. So a lot of tailwinds for the company, and I really like I like the way management are approaching it, right? So that announcement that the CEO came out and announced, I like that he's foregoing the short-term gain for the long-term health of the company, essentially, right? I really like that he's sort of not thinking short-term, he's more thinking along, you know, 5-10 years down the line. So this company definitely has, in my opinion, a lot of room to grow, and they've been compounding at around 40%. Their top line around 40% over the last, you know, couple of years. So very impressive growth, very strong balance sheets, and the company is only reinvesting in themselves. So I don't know if you guys can tell, but out of the three that I've gone over today, this is the one that I'm most interested in at the moment. But however, this is not buy advice. You got to do your own research. But yes, that's essentially the company in a nutshell. So a very brief summary, and you know, a few reasons why you might want to add this one to your watch list. So guys, that's the video for today. Just do keep in mind though, none of this is a buy recommendation, none of this is financial advice. This is all just for education and entertainment purposes only. You know, you should do your own due diligence. You know, some of the things that I'm saying today you might not agree with. You know, some of the assumptions that I'm making might not make sense, or you might not agree with them, right? And that's all investing is what are the assumptions that you're making to get to the price that you want to pay, essentially, right? What are you willing to pay? Now, again, guys, none of this is financial advice, so do your own due diligence, do your own research. But thank you for watching the video. Don't forget to like the video and subscribe. It does help the channel out a whole bunch. You know, if you enjoyed this type of content, I've actually got videos on the screen now that's gonna, you know, help you get a little bit better with investing, and hopefully help you get closer to your financial goals. But guys, until the next one, I will see you then.